Martin, I reckon one of the best kept secrets in the whole superannuation world is the spouse splitting. And Monica actually asked in our Facebook group, and if you do want to join our Facebook group, can you please just put, when it says, where did you hear about us, please put episode 325 or an episode number so we know that you are not spam.
Human.
We want to know that you're human. Monica said, perhaps you can do a podcast on super splitting. There doesn't seem to be much info available on this. So we're not doing a podcast, Monica. We're just going to talk about it.
We're doing a question.
We're doing a question within a podcast because I don't think we need more than kind of 5-6 minutes to talk about this. So what is super splitting?
Yeah, so I agree. It's probably underutilized strategy. So basically it is splitting some of your super from one member to another. Now, we're not talking about getting a divorce and splitting your super that way. That's a whole other path that we're not going to cover off today. This is, you're in a relationship, you continue in a relationship, but you want to move some money out of one spouse's super to another. How does it work? And we'll then talk about when you might want to do it, but you can only do it once a year, and you can only do it with the concessional contributions that have gone in from the prior financial year. So let's use an example. Let's say myself and my wife, I might put in $10,000 concessional contributions for myself, either from my employer or personally myself. That goes towards my contribution cap and I get that tax deduction. I then pay 15% inside of my super on that, and that leaves with $8,500. If I do nothing...
Or 85%.
Or 85%.
Which is the maximum.
So 85% is the maximum, 8,500 after that 10,000 figure. I then do nothing. That stays invested in my super for a long period of time. Or I might say, actually, you know what? I'm happy to move that 8,500 to my spouse. I fill in a form. It's an ATO form. Some super funds have their own form, but generally they all accept and use the ATO form. Send that in. I can only send it in after the financial year has happened. You can't send it in while you're still in the same financial year, and you also can't go and backdate for the last 3 or 5 or 10 years. You can only do it for the previous financial year.
Is there a sunset clause or window after 30 June?
No, it's
just during that financial year.
During that financial year. So I haven't tested it, haven't tried to sweat this much, but probably the 29th of June, you could do it for all of the year prior, but you're leaving your run pretty late. But it's technically the end of the following financial year. Super fund processes that. There's a withdrawal from my super fund of $8,500 and a deposit into my spouse's super fund for $8,500. No extra tax.
I don't get tax components follow and attach to it?
Stays as taxable.
Right.
Yeah.
And the reason you can't do it with non-concessional is because the spouse could have just put the money in with non-concessional anyway because it was already outside of super?
Yeah, so... You just can't. There's probably various reasons why you can't, but you can only do concessional. You can't do any earnings. You can't do, as you mentioned, non-concessionals. You can't do insurance proceeds. It's concessionals from the year before. That 8.5. Now I might have put that in I don't know, July of 2025. Let's call it. Depending when you listen, this might be in the future. Depending when you're listening to this or in the past. Now. It's going to sit in my super account for the rest of that financial year and maybe for another 3 or 4 months until I do that form. It might have gone up. It might be worth $9,500. It might have gone down. It might be worth $7,500. But the whole amount gets transferred across.
Okay, so if the account did lose value because of market fluctuation and that 8.5 of the portion of the contribution was $8,000 now, I could still elect 8.5 and they'll take that $500 from capital.
Assuming if that's the only money in my fund, then they won't. But yes, assuming I've got a balance in there of whatever else to cover that shortfall, they'll still take the full amount.
And when might someone do this super splitting and why?
Yeah, so a few reasons. Your spouse might not be contributing, so you want to just still keep theirs growing, just as a nice thing to do for your partner, Valentine's gift maybe. 2, it might be that your partner's older than you. And the strategy we often use is you split it to the older spouse because that means that you get access to that money sooner.
But it could also work the other way, couldn't it?
There's a Centrelink sheltering strategy. Yeah. You may want to split it back the other way. You might want to keep yourself below a certain limit. We've done podcasts talking about if you're below 500, you're below this certain threshold. And so, and if you've got one spouse who's got 400,000 and heading fast towards the 500,000 threshold, the other spouse has only got 100,000. If you super split $10,000 or $20,000 a year across, that's going to slow one person by not growing as fast. But often, we'll use it for spouse one's 48, spouse two's 58. The 48-year-old can't access their super for a long time. Spouse who's 58 can access it relatively soon. Let's split that up to the older spouse.
And it's also a good tool if, a lot of this audience have passed the family stage, but it could be a good tool if one member of the couple is on maternity or paternity leave for a year or two. You might just go, all right, during this time we'll put all the super over there or halve it.
Yeah, the working spouse still needs the tax deduction, but we want to split it across the other spouse. It may be there's insurance premiums to come out of that non-working spouse's super balance. And so if it's being, those insurances are important to keep, but we need money in there to fund them.
Yeah.
That's the way to split them across. So,
okay, question, and we are going to talk about the notice of intent to claim, but if I was self-employed and I put a $20,000, we'll use your 10 actually, I put $10,000 into my super fund on 30th of June for general tax planning, I have to then, after the end of June, do the notice of intent to claim form. So the ATO would then remove 15% tax or the $1,500. I can only do this spouse split on that 10K once it is
after it's been
I've
allocated.
done that notice of intent to claim.
Yeah.
And I think you might be thinking, well, why wouldn't you just pay the $10,000 directly to the spouse? Well, the situation may change. You might have done it for a broader tax strategy for that income earner.
Yep.
So we don't get carried away there. But I think it is an unused and unknown strategy, particularly for those younger people. And if you've got kids that are about to start having babies and someone's taking some time off workforce, send them this episode or this clip. We're like, hey, your partner you guys need to talk about this and split some of those super contributions while one of you are off work for an extended period.
And 100%. And then a more longer term planning, obviously there's new $3 million super tax. You've got one spouse who's on $300,000 a year for the next 30 years of their life and
other one's on 80 or 90
or not working
50,
at all.
Not working,
They might reach their $2 million transfer balance cap or their $3 million tax. Hold on, I wish I super split for the last 20 years. Two more bits of insight. We said there's not a whole episode, but there's lots to talk about. One, you can only receive that until you've met your preservation age. So 65, we can't super split up after someone's 65 or they've retired after 60, so we can't super split forever. And also, if you use because I know you were going to think and ask this, what if you do a big carry forward, I sell a rental property, I put 100,000 in, can I super split the whole 85%? That short answer is yes.
Yeah, okay. So there are some ways to pluck this chicken. Anyway, there you have it. Bit of information about super splitting. Let's do a podcast.
Let's go.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
We're back.
There we go. Don't get too relaxed.
Yeah. Oh, gosh. We're trying a few tech things here. All right. So there's an anonymous question that came in from the email, I'm pretty sure. I was wondering if I could ask an anonymous question here rather than the Facebook group. If you were receiving an inheritance after you've retired and reached age 60, can you open a second super/pension account, so not accumulation, and put the inheritance straight in there rather than in an existing super fund. The reason for this would be to keep each fund, this is interesting, under the 1.9 million, which is the balance transfer cap, which is from 1st of July will be increasing to 2 million. Also, if this is possible and the second one was deposited in one go after 60, would it then be exempt to tax for my children if I was to die? Where the dollars in the other pension account, which would have come from an accumulation fund, would be taxed to my kids if I die, if I did the transfer every 3 years into another pension account. So a lot there. My first view is, Martin, there's a few crossed wires there. So maybe we can strip back and get back to some fundamentals to help Anonymous understand. So do you want to take it from...
I can take it from the top. If I'm 60 and retired and start to draw a pension and all of a sudden at 65 or 70 I get an inheritance, can I put more money into super? The short answer to that is yes. You can keep making, as long as you're eligible, non-concessional or voluntary contributions to super up until the age of 75, irrespective of whether you've retired or not, or irrespective of whether you've started a pension or not.
And I just want to flag when because I know I saw her name, can you open another super/pension account in brackets, not accumulation? So just the nerdy technical thing, anytime you open a super account, it's default in accumulation. And often, but maybe you can correct me on this, not always, most products, if you wanted to start a superannuation pension, can you rock up to funds and be like, I've got $1 million, put this straight into a pension, or will it always go through the super accumulation door, even if it's for half a day?
It depends on which product you're using. Some of them will need a whole application for accumulation. Many of them now, and I suppose particularly the wrap or more advisor products, you can do a pension application.
From day one.
From day one. And what they will do is they'll wash it through their trustee account, and so it'll be an accumulation for 12 seconds.
Yeah, and that's kind of what I was getting at. Like on the nerdy level, it always will go through the accumulation door.
Whether it's two different forms, old school, or whether it's, but yes, even they would need to put it through an accumulation for 10 or 12 seconds.
Yep.
But that's more seamless than 10 days later send this other form in.
Yeah. And then put the inheritance straight into rather than an existing super fund. Okay, so is the crossed wires here, the 1.9, are we assuming that's the balance transfer cap? Or is there another 1.9 figure that I'm not
No, I think that'd be the
aware of?
transfer balance cap that she's referring to, or Anonymous is referring to. So what that's about is, again, we've discussed this on a separate podcast, but how much can I move into pension phase? And therefore, if someone has already used that 1.9, what I said before, if you can do it up to 75, is kind of off the table now. I.e., if you've already got 1.9 or $2 million in pension phase, can I go and put an extra 360 in? No, you can't. You've already got too much in super. But that's actually, again, I'll try not to get too boring or too excited, but that's actually as a result of your total super balance being too high, not your actual transfer balance cap. They are the same figure, but they're two different actually tests.
Yeah, okay, but either way, both of them are a global individual level, not a fund level.
Correct. If you've got one fund with 2 mil and another fund with 0, you still can't, I've got nothing in this fund. As a member, as an individual, you've still got your 2 million or your 1.9.
And I think this is probably why we're such advocates for personal financial advice, because Anonymous is clearly in the Facebook group, listens to the podcast, sees all this stuff, knows conceptually that we can, if money is quarantined here, we might be able to get paid tax-free, and this here and this there. But at the end of the day, it really wouldn't matter if all this was in the one account in terms of the wash-up of tax for the children or the adult cis beneficiaries.
No, I think we come back to that. But even stepping back, like you mentioned there, if Fund 1 has already got your pension at 2 mil and you go to fund 2 and go, can I put 360 into here? They're probably going to say, yeah, no worries, put the 360 in, because they don't know about the other fund.
Yeah, but the chickens will come home.
6 or 9 or 12 months later, the ATO reconciles, and because fund 1 and 2 send it to the ATO, and they go, oh, you've got too much. You can't do that. They'll contact the second fund and go, hey, or they'll contact the member, but the fund, and go, hey, you need to reverse that transaction. Oh, by the way, that's been in here for 9 months. These earnings and these tax-free earnings, you've got to adjust that. You've got to pay us all this extra tax. And so, yeah, you might be able to accidentally get away with it, but you're not going to know for 6 or 12 months later, and all of a sudden this money gets refunded. You've actually got to pay this extra tax because it's been in their tax-free status when it shouldn't have. So,
because, sorry, you keep
going.
I
mean, and it's not the second fund's fault. It's not their responsibility. It's the member's responsibility to know this.
Yeah. And then she went on to say whether the money in the other pension account would have come from my accumulation fund.
It might have taxable components.
Taxable components, unless if I die, unless I did the transfer every 3 years into a pension account. So
I think recontribution there.
But you'd only do that once.
If you've got a large balance, and so I think the essence of that question of, let's say I've got
every 3 years when the caps reset. Yeah.
So part of what we're talking about then is if you've got 1.92 mil, you can't do this anymore. But let's bring it back. Let's say we've misinterpreted and we've only got $1 million in pension. Can you go and put 360 into a new pension? Yes. If you go and put that into a second fund, that would be a 100% tax-free pension, and then your kids would inherit that tax-free. Whereas your other one might have taxable components. That I agree with, that's correct. But if you put 360 in with that million and you had one fund worth 1.36 million.
There's a pro rata.
Still pro rata.
Yeah.
There's not actually more or less tax. You're not quarantining it, and she's probably quarantining with 2 different funds, but it doesn't go, this is majority taxable, so it's all taxable. They still pro rata it. They still underneath have the components. So I probably, in saying that, I'm working on a strategy now where we are setting up 2 separate funds to quarantine it. Unless you know you can get close to zero, I probably wouldn't sweat about having 2 different funds. Again, horses for courses, how important that is for you. But
the thing is,
it's prorated, so you're no worse off. It's more around if you're going to keep recycling and maybe get yourself closer to zero.
This every 3 years doing these strategies, you will end up capping out your age anyway, or potential super balance.
Yeah. So I'm back the opposite.
And how
of what
much paperwork do you want?
So if you're 74, you're not going to have enough years.
No.
So you just put it all in one. But if you're, say, 65, let's go down this path. You set up a second fund, that's all tax-free. You've got your other $1 million in your taxable. In 3 years' time, you take 360 out of your taxable, you go and put the 360 in your tax-free fund. So now that's up to 700 odd, and your million's down to 700. You're 68. So at 71, you do it again. You take the 360 out, you move it to your second fund. That's now $1 million tax-free. The other one's, call it magically 360 taxable. At 74, you do it again. So you've got that 10-year window to move it all from taxable to tax-free. That's by why you would run 2 separate accounts to do that, if you've got the window to do that. And if that's your priority, that can be pretty substantial. If you're not going to have enough, years on the board to get it done, or it's not a high priority, it's then about, is it worthwhile having 2 accounts and paying, an extra couple $100 a year in admin fees and the headaches of having 2 accounts versus one? That's up to you, I suppose.
In terms of this strategy with the inheritance, it's like, okay, if it's an $8 million inheritance, you're probably not dicking around doing this stuff because it really just isn't moving the needle.
Comes down the wash, yeah.
But I think it's circumstantial on the amount. If the inheritance just stayed outside of super for the kids, they can inherit it tax-free, but they just get a cost base, right?
If it sits in cash the whole time,
it's
fine. If you go and buy some shares or a diversified fund...
Well, we're not probably going to have money in cash for next
I would hope not, but you never know. You put it in your principal place of residence tax-free. So, but if you go and invest it like a super fund, you're going to have some taxable income while you're alive, and then you're going to pass on an inherited cost base, and then your children get advice as to when and how they should sell or deal with that. But the idea of moving into super, you should be first or second on the list. Am I eligible to move into super? No, I'm not, because I've already got too much. Okay, well, that's off the table. Or yes, I am. Do I put it in the same fund? Do I put it in a separate fund? But step one is check if you are eligible first.
Well, I think anonymous, the thing that will probably just have a big reset is it reads here like she thinks the 1.9 million is fund level, not global. So that would probably cause her to rethink everything, maybe.
Yep.
So,
Yep.
Julia, hello Brains Trust. Hello, Julia. I'm considering putting in an after-tax contribution to my super fund. I know I have to complete a notice of intent. Question: do I put the money in first and then complete the form via my super fund or with the ATO? Ooh, well, we probably want to put the money in first in that financial year.
The ATO or your super fund won't let you claim something that's not there. That'd be a great deal, actually. You put the claim in, you put the money in. No, the money's got to go in first, and it's got to clear. Now, sometimes you can transfer the money today, send the form in, and by the time they've got the money, they process the form. That's okay. But generally, you wait to confirm they've actually received the money before you send the form in. Do you contact the ATO? No, you contact your fund. There is an ATO form you can send to your fund, but most of the funds now, online through their portals or directly, you can do it. The notice of intent to claim form.
Yeah, it's a little tick box usually.
But you do it with your fund directly, not with the ATO.
And when you do it, so for example, I'll just make a scenario up that really means nothing, but Julia might put $50,000 in at the end of June. And there's a few other moving parts. Within the next couple of months, she can work out, okay, so I put that extra 50 grand in because it wasn't salary. I mean, the difference is you could effectively do salary sacrifice throughout the year and then it's automatically done without the form.
Yep.
But she's put the 50 grand in. Okay, June's happened, wash up of some other assets and income, and we sold these shares and that. They could then work out when they fill their notice of intent to claim form in, the form will say, how many after-tax contributions did you put in? She'll put 50,000 and then she'll put, and then it will ask how much of this do you want to claim on tax or effectively turn into a concessional contribution. And she might go, oh, actually, we're only going to do $10,000 because we want $40,000 as a non-concessional and we'll just do $10,000. Puts the form in, their super fund will then take away $1,500, which is the contributions tax, and move the remaining $8,500 into the taxed component where the $40,000 stays in the
non-concessional
tax-free, blah, blah, blah. So there is a bit of flexibility, but to the question there, 100% money in first, and then second 100% is at the end of the financial year, and do it sooner than later. You might wait till you do your tax return with your accountant, but you're going to need to have that sorted before you do your personal tax return, because on that tax return it will say, have you made any contributions?
Yeah. Do you want to claim? I agree. Different to the super splitting that we mentioned earlier, you cannot do that until after 30th of June. You can do a notice of intent in the year that you're in. Is that the right thing to do or not? It depends.
You might just be like, I know it's...
I can only afford to put in 5.
I'll do it now.
I need to claim the whole amount.
Yeah, and I'll move the components.
And that could be in August, even though there's 10 months left in the year. And sometimes that's the right thing to do.
Yeah.
If you know that's all you're going to put in and you know you're going to claim the whole amount, just do it so you don't forget.
Yeah.
But the form doesn't have to be in by the 30th of June. It doesn't have to be in by, July or August or whatever. It's got to be in by the time you do your tax return.
Yeah.
And so that's the right order. And then again, to get more relevant around that as well, some of the traps that we see, if you've taken money out or you've started a pension with it or you have done even some super splitting to your spouse, some of those withdrawals or transfers might change the amount you can claim and or mean you can't claim it at all. So you go and put all that money in June. You go, I'll reconcile it in July once I figure out, my advisor or my accountant's going to tell me how much exactly I can claim. But in the meantime, I better start a pension to start living off that money. That door's been shut and you can't open it again.
The second biggest trap that I see are people leaving it too late. I think last year someone wrote in and said, I wanted to make a non-concessional contribution or a personal contribution to super, then effectively fill out the intent.
To claim it, yeah.
They left it too late in the financial year. That money rocked up on paper on the 3rd of July or something.
Yeah.
Too late. Now, this episode is coming out on the 26th of June. Probably too late. Probably today is your last day because you've always really got to allow for 2 days, 2 full business days, particularly if you're doing BPay.
Yeah.
If you go, BPay may show up the next business day if you're getting before the BPay cutoff, which I think is around 4 or 5 p.m. Eastern time. But I tell people, start of June, you really want to get that sorted to avoid disappointment.
Because it's not when it leaves your bank account, it's when the fund receives it. And most funds now will have a date on there. Or again, the cutoff I think is probably already gone, but they'll advertise that. And
But it will be their soft cutoff.
Yeah.
And
we've got a weekend this year as well, so it's eliminating a couple of these days towards the end. So
there we have it. We'll be right back after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
This is a fun one because I think, Richard says motorhome, I'm thinking boat. Richard asks, if you retire, sell your home to fund a motorhome to travel Australia, can you claim the motorhome as your primary residence and therefore not included in your assets?
Short answer, yes.
Because effectively, the ATO or Centrelink, they don't say a dwelling or a house.
It's where you reside.
Yeah, it has to be a 2-bedroom brick house or whatever.
Yeah. So if you're residing in a caravan or a boat or a motorhome or a portable home, that can count. It's a bit more involved as to whether you'd want to or not, in that we won't do a deep dive on Centrelink now, but in Centrelink's rules, what's Richard asking is, if I go put $100,000 into this asset, I don't want Centrelink to count that as an asset for me because that's my home, that's where I'm living. In Centrelink's rules, you either treat it as a homeowner or a non-homeowner. And so if you're a homeowner, the value of your home is ignored, but you get certain thresholds. If you're a non-homeowner, well, then the value of your asset might be counted, but you get higher thresholds. As it stands now, the difference between a homeowner and non-homeowner is around $220,000. So I'm not giving advice to Richard or anyone directly, but there is a circumstance element to this. But if it was a pure financial thing, if your motorhome's $50,000,
and you just sold your house for $500, what are you doing here?
Yeah,
just keep the house.
Yeah,
because if you kept the house, even if you put a
Rent
tenant
it out,
in it,
yeah,
or whatever, or just literally left it empty, life's easier. I don't know.
And that's definitely part of it. There are some exemptions if you sell your house. How long
18
selling
months?
Doesn't count it for. I think they've extended it.
Right.
I think it might have been pushing 2 years now.
Wow. If
Take
I
that on notice.
zinged the zinger.
Yeah.
I like to try
It doesn't happen
get
all the
mine.
time.
It
Usually
doesn't.
quick turnover, or usually, it might happen within 2 or 3 months. We don't have to worry about it pushing out too long. But the subtle hint or that I'm trying to suggest there is that you jump through all these hoops so that your motorhome doesn't get counted of $100,000, but then they reduce your asset test by $220,000. You're better off having that counted because instead of your cutoff being $400,000, it's now $600,000. Even if they count it, unless you've got a very expensive motorhome, you might actually be better off. In saying that, there are other elements of rent assistance and park fees and those kind of things that you can claim depending upon your status of a homeowner or a non-homeowner as part of this Centrelink application. So more detail, but yeah, there's definitely, if there's a will, there's a way.
Yeah, but it goes back to we're not doing stuff like it's first and foremost a lifestyle thing. Like, what do you want to do? Well, we want to get a motorhome to travel Australia. The only way we can do that because we want $130,000 Winnebago or $200,000 Winnebago or whatever they
is we need to take this capital out of there.
Yeah, it's like there's actually no other money, and maybe it is that we want to do this around Australia for a year or two. When we get back, we know we wanted to downsize anyway, so let's sell the house, buy the big Winnebago. We won't take any extra money out of super, leave that there, and then maybe put the money downsizer into super and go on your merry way. But if you're coming back in 2 years, are you going to buy somewhere? Well, are we pulling money back out of super to do that? Or are we just leaving money in a...
Parking it somewhere.
Parking it, term deposit or whatever. So I think I'm always a big fan of leading with, well, what do you want to do?
Yeah.
Not, well, I think we might be able to get an extra $5 a day out of Centrelink if we do this and all that. And it's like, yeah, but at what cost?
It's a long way the shortcut. And yeah, what if you paid in transaction fees and agents fees and stamp duty,
and just general dicking around.
Yeah.
Where we know if you did leave the house for 2 years, sure, you'd probably still be treated as a homeowner. But if you did want to sell the house, it's within that 6-year rule anyway. It's not going to be subject to capital
issue.
Yeah, so I don't know. It's a fun question, and
Yeah,
that's where I thought. I'm like, because I've always thought about, I wonder if I buy a really nice boat and moor it at a marina or something and just live there. That'd be fun.
Yeah, I don't know how many Centrelink offices are close to marinas, but there could be.
Yeah.
I was going to say something else. No editing.
He's lost his train of thought.
Lost my train of thought. It was a good one.
But if you don't get it back, we're going to end it there. Or have you
I've got it back, but it's probably not worth it.
It won't be.
It's going to be a joke. But what you cannot do is you cannot claim your house and your caravan or house and the boat. It's one or the other.
Yes.
Even if you spend 3 months in the caravan, 3 months in the house, can I claim them both? No.
Yeah, pick a lane.
Pick a lane, enjoy it, live it up, and Centrelink will deal with themselves as they need to.
Yeah. Well then, I was just thinking we just don't know so much because I was thinking, well, if there was money in super, do we just pull the money out of super and buy the Winnebago and then when they want to downsize in the future?
There. And if you're a couple, can you hide it in your younger spouse's super accumulation? It's not counted for Centrelink assets and test, etc. There's some moving parts.
But Richard, put a photo in the Facebook group of your your new home on wheels. And remember, you're not doing that as an investment. Things with motors and wheels go down in value, and that's okay. You're allowed to spend money on whatever you want.
And those memories can go up in value.
Oh, look at you, Gandhi. All right, we will leave it there. Short one today. My name is Glen James, joined by Martin McGrath. If you do find this podcast useful or fun or whatnot, if you want to leave us a little review on Apple or Spotify, or give us a like and a comment on YouTube, and maybe in the YouTube comments, I want you to write, do you think you'd be a motorhome, caravan, or boat person?
Caravan, if you know about me.
Yeah. Thanks, Martin.
Thanks, Glenn.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.